Major funding for these broadcasts has been provided by grants from New York Community Bank, M&T Bank, PBM, Customers Bank, Collins Building Services, AmTrust Title Insurance Company, Marks Paneth, Capital One Bank. Additional funding for these broadcasts has been provided by grants from Amerant Bank, Bank of America, Citizens Bank, Dime Community Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC Handler Real Estate Organization, Hodges Ward Elliott Inc., Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Catsimatidis Red Apple Group, Keysight Capital Partners, New Banks, Meridian Capital Group, Ocean First Bank, People's United Bank, RPW Group, TD Bank, and these friends. Hi, this is Mike Stoller trying to interpret with certain tax experts the new Tax Stimulus Reform Act, or a variety of things, as I call it, the Accountants and Lawyers Act, to explain to clients. Today, my guest on this show is Mark Barron, who is principal at Marks Paneth, Mike Greenwald, who is a partner at Friedman LLP, and Abe Leitner, who is the director at Goulston and Storrs. So last week, we tried to get a little bit of the meat on the new act. So today, let's try to discuss what effect does this act have on small businesses and on individuals. Mark, you were talking about depreciation before, buildings and other things and credits.
Well, right. The bill we didn't get into last week really covers quite a bit of tax extenders. Every year, that's what they're known as. Certain provisions expire. There's a lot of efforts to make permanent. There's also some changes that have been helpful, and you mentioned depreciation being one of them. So that's a laundry list. Some are permanent, and some are for 1 year, some are for 3 years, some are for 5 years. It really all depends on the particular credit. The credits are very important because dollar for dollar, they reduce your tax liability, your taxes, as opposed to a deduction, which is a little less valuable, but valuable nonetheless. So these tax extenders are very important. Tax deductibility also is very important with respect to how we're treating costs related to PPP. And there's unrelated COVID matters too, as well, that are included in here that relate to disasters. And then of course, additional types of credits that have absolutely nothing to do with COVID. So this is an omnibus bill. It included a number of different laws that were pending for a while. And some of them were specifically targeted toward COVID. Some are targeted that would have had to been enacted anyway. So the tax implications here for both individuals and for businesses and certain types of businesses, there's something in this bill for every single type of entity.
Let's talk about small nonprofits. They were not able to get any money before, and many of these nonprofits have had a significant reduction in their revenues because people aren't contributing as much before. Abe, have you seen this with any nonprofits or any thoughts with some of your clients?
I think this was more of an issue for the wage retention credit and PPP loans, which I think many nonprofits did apply for. But one of the clarifications in the new bill is that a not-for-profit that has a significant reduction in donations can count that as the reduction in gross receipts, potentially allowing it to then get a wage retention credit so that it can keep employees on payroll while it's struggling through these times.
Yeah, I mean, the issue for not-for-profits is always that, these this type of legislation is written with businesses in mind, and not-for-profits tend not to, record revenues and expenses the same way that an operating business would. There's also provisions in here for certain types of not-for-profits. I think 501c6. I try not to memorize code sections, but it can't help it. But certain 501c6 civic organizations are now eligible. And these are important organizations to communities. And because of the way the PPP loans were structured, remember, the original PPP loans were just grafted onto the Small Business Administration Loan Program, which again was never aimed at not-for-profits. It's a Small Business Administration program. So these local civic organizations that support the community and are critical in this type of an environment where local communities are suffering a lot of dislocation, they weren't eligible for PPP loans. So their donations were down. The need for them was up. They couldn't keep their employees employed. So now the second time around, they've been included, which should provide some relief for community organizations.
Let's look at something different. Let's talk about a self-employed physician who may be operating as a PC. Let's review pre-PPP and today. How would they qualify if they qualify? Because their income may be more than a certain amount per month.
So talking about the limitation in the PPP loans that you can only count $100,000 of annual compensation, and that hasn't changed. That's still the case. Is that whether you're operating as a partnership or as a PC, regardless, it's still the maximum compensation is $100,000 that can be included. There's a mathematical limit to how much that physician can borrow. The good news is, they could qualify for these second draw loans now as soon as the banks, as soon as the program actually comes into existence, and as soon as the banks start issuing the funds. So there'll at least be a second bite of the apple for that person.
In the same vein, let's talk about professional firms like yours, okay? Any of the professional accounting law firms and so on. Do you believe that they will be applying for PPP or for some grants?
One of the challenges for professional firms is it's a condition of the PPP loan that you certify that there's a financial need for the loan based on current conditions. And people have to really get comfortable with making that certification. You have to look at what is really the impact on the business, how much are revenues down. Are you really in a position where you would need to be laying off employees? And if not, are you permitted to certify that you have a financial need for the loan if it's just replacing revenue? I think most professional, certainly most larger law firms and accounting firms did not apply for PPP loans for that reason mainly.
Remember that the second draw loans have different requirements. The first draw loans, you had to certify that there was economic uncertainty, that you just weren't sure what the future was like. And back in April, when the loan program started, nobody knew what the future was going to be like. The second draw loans have a mathematical feature to them, in that you have to demonstrate that you had at least one quarter in 2020 where there was a 25% reduction in revenue. So for professional firms that did suffer that because their client base, was suffering during 2020, there may very well be a situation where for those smaller professional firms with 300 or fewer employees, where they may need these loans. So it's just going to depend upon circumstances. I would expect.
I want to clarify that all these businesses, less than 300 employees, correct?
That's correct.
Let's try to discuss the deductions for businesses and individuals, and then the credits for individuals and businesses. Abe?
Sure. So the original CARES Act included an explicit directive from Congress that the forgiveness of the PPP loans was not going to be taxable income, because usually cancellation of debt income would be taxable. The IRS issued a notice several months after the bill came out saying essentially that, well, if you are not going to be taxed on the forgiveness of the loan, then if you use the proceeds of the loan to pay expenses, you shouldn't be able to get a tax deduction for those expenses. I think that a lot of people in Congress were surprised at that result, although it's probably arguably technically correct based on the existing precedents. But I think people in Congress thought that they were actually creating a benefit by allowing people to exclude the income, when in fact, if you lose a deduction when you pay the expense, you're really in the same position as if you wouldn't have been forgiven at all. You end up net with the same amount of income. As the year was coming to a close, many advisors started looking at this question and said, look, many clients aren't going to see any forgiveness until next year, potentially, and who knows whether they'll be eligible. So given that we don't really know if the loan will be forgiven, there's at least a position to be deducting the expenses this year, even if it's possible the loan will be forgiven. The IRS kind of doubled down on its position and issued a revenue ruling, essentially saying, no, if you have reason to expect that your loan will be forgiven, you can't deduct the expenses either. A lot of people in Congress, I think, were kind of upset at the position the IRS took, and you saw this in the stimulus bill. There's now a clarification that not only is the forgiveness excluded from income, but any expenses that you pay with the PPP loan proceeds are deductible, even if it is going to be forgiven. And it's interesting that I guess the drafters were worried about the IRS trying to do an end run around it again. So there are some interesting clarifications in this bill that you don't usually see in exclusions. For example, there's a rule that says if you're a partner in a partnership that paid these expenses and it's forgiven, the partners get a basis step up for the forgiveness, which allows the partners to take advantage of the benefit inside the partnership. And that's something you would think would happen automatically, and it's an unusual thing to have to make clear, but it looks like the drafters were worried that the IRS would try to shut it down and say, okay, but we're not going to let the partners get the step up. So Congress said, no, this time we really mean it.
Mark, you have a comment?
Well, no, there's a timing element to this as well. And this is really relevant to year-end tax planning. Your basis increase, which supports a lot of deductions for partners and S corporation owners, occurs when the loan is actually forgiven, which in most cases is going to occur in 2021. So at the end of this calendar year, it's a calendar year taxpayer, if there's a deduction that's available and there's not sufficient basis, you may be in a situation of having a suspended loss that may carry over to the next year when the loan is actually forgiven.
Yeah, and that's even more of a problem for S corporations, because at least in the partnership scenario, you get basis for the loan itself. You may not have, and we're getting into deep tax geek stuff, but you may not have at-risk basis, but in the partnership, at least you might have basis. In the S corp, you wouldn't have basis at all. And for those who want to discuss tax history, there's an old tax case called Gitlitz, which was the reason why they had to make these comments about the S corp, because there's actually specific statutory language because of the Gitlitz case that says that S corp shareholders don't get basis for tax exempt income. So, this is all deep in the weeds tax stuff, but it's really, to the three of us, it's fascinating. We could talk about it all day.
With regard to the 3 martini lunch, what's your thoughts about that?
Well, first of all, stick to 2. But there is now for 2021 and 2022, you can deduct all 3 martinis if you want. There's 100% deduction for business meals for those 2 years. And clearly that was put in to help the restaurants, but it's clear that it's only for restaurant meals. So it's not for catering, it's for restaurants, whether you eat in, take out, or have it delivered. So contact your local restaurant delivery.
Written only for restaurants, so it's not if you went to the Madison Square Garden and you had.
Unless you eat at the restaurant at Madison Square Garden.
We're talking about food and beverage. Right. Yeah.
That's an interesting clarification. What about the payroll tax provision that you could postpone the payment of payroll taxes?
I think that's an important benefit. That's many employers. There was an executive order that the president signed, allowing the employees' portion of payroll taxes to be extended, or with, not paid until the end of this year. That's been extended, I believe, into the end of next year, at the end of 2021. And the payroll tax provisions are really a hot button issue. It's easy to make changes to the payroll tax rules. There's changes that relate to credits related to payroll taxes that you can get under the Families First Coronavirus Act, which actually was the precursor to the CARES Act, which allowed for tax credits. And all of these credits are still valuable, and they've been extended to later years.
With regard to, in the first act, you were able to not take your pension benefit this year in 2020 if you wanted it that way. Is there a provision that way that it's going to be there for 2021, that you don't have to take your regular payment from your 401k?
Are you talking about the required minimum distribution?
Right, the required minimum distribution.
I don't recall if that provision was in this law.
I didn't see anything about that, but
Yeah, I mean, there is a different provision that relaxes the rules for a kind of emergency withdrawals and loans. So you could take up to $100,000 instead of what would normally be 50 if it's a result of a natural disaster.
With the first act, everybody ran quickly as possible to apply. Based on the discussion that I'm hearing now, coupled with what we saw changes and no clarification, you have the SBA, you have the IRS, you have all these different organizations who are going to chime in. What would you say to your client? Should they wait until the rules are clarified, or should they apply because they're worried that there won't be any money there in the future?
I think that's a great question, because clearly clients that are in need don't want to wait for implementing guidance. As a practitioner, we like to see more certainty, and I think we need to find a balance on the client's needs, congressional intent, assist in any way we can. But I don't think there's a hard and fast rule that says wait for this guidance. As Mike and I discussed earlier, there's different types of expenses that still need to be clarified. We don't know what they mean, like a covered supplier expense. So we like to see, as a practitioner, answers to those questions. We're hoping in the 10 days that SBA has to produce rules, there'll be some helpful guidance. But waiting sometimes is not in the best interest of the client.
You bring up the SBA. The SBA is going to be taking care of additional guarantees on certain 7A loans and other loans by the SBA. It was difficult enough for them to handle the first round. Now, how do you handle the first round with also taking into consideration additional loans to pay off?
yeah, it's going to be difficult. I think one of the opportunities here is, while the SBA is in the middle of trying to approve all these second draw loans, assuming that we have a clearer understanding of maybe the optimal way to apply for forgiveness on the first draw loans, there might be a window of opportunity to get in there and apply for forgiveness on the first draw loans. Because remember, there's timeframes in which they have to approve the forgiveness. So maybe get in there for forgiveness while they're overwhelmed with second draw loans. But
So my question, and maybe it's for Abe and all three of you, what's your thoughts about people who got the loan applying for forgiveness today? Or should they wait also?
right now we're telling them to wait, because there's so many, especially with the new bill, there's so many new interplays between, what wages count for PPP loan, what wages count for the retention credit or for the R&D credit, what these new expenses, as Mark was pointing out, we don't know what covered supplier costs really are. So our advice to clients is sit on your thumbs, just wait.
Right. It's especially true if the client believes that a portion of their loan may not be forgiven because there are so many new types of costs that are now eligible. Much more of the loan could be forgiven. And so there's a lot more flexibility built into this. Waiting, you have 10 months until the end of your covered period on which to apply for forgiveness. So there's plenty of time to do it. I certainly appreciate that clients are anxious to get this behind them. But if it can maximize their forgiveness, it's worth it.
What are the major points with regard to tax credits? And what are the major points with regard to other types of cash benefits and checks and so on, stimulus money?
Yeah, I mean, one thing we haven't really touched on is there's a whole set of tax changes not really related to pandemic relief. One is going to be important to a lot of real estate operators, which is we have a limitation in the code now, section 163J, that limits interest deductions for all businesses to 30% of gross income generally. And there is an election out of that limitation for real estate companies, which most real estate companies are taking advantage of. But one of the trade-offs in the original legislation was, in order to make the election out, you had to agree to a slower depreciation period for your real estate. And while the difference isn't that big for most classes of real estate, it was very significant for multifamily residential real estate that was acquired before 2018, where essentially, in order to make this election, you were going from what would have been 27 years to as long as 40 years. This new bill includes a clarification that reduces the depreciation period for that specific class of pre-2018 owned real estate to 30 years versus 27. So it becomes a lot easier for those businesses to make this election out of the deduction. I think a lot of businesses will take advantage of that.
Mike, what's your?
Yeah, no, we agree that that is going to be a huge change. Plus, you know, the way it's drafted, it's retroactive to the beginning of this 163J provision. So it actually covers 18 and 19. And the question is going to be whether for some of these clients, they want to go back, and if they made the election and are using the longer life, whether they want to amend their returns or whether there's an opportunity for a change in accounting method to try to recapture that additional deduction that that they could have had that they didn't take. So, you know, there's going to be an opportunity there. You know, a couple of other things that came in, you know, Mark alluded to earlier, there's a lot of tax credits that were expiring that have been extended either permanently or temporarily, and some of these benefit real estate. So there's there's a deduction in section 179D for energy efficient buildings. That's one of the things that expired every couple of years. That's now been made permanent. There were companies that were doing solar installations that the solar credit was going to change from 26% to 22% at the end of the year. That's now been extended. So companies that were owners that were going to put in installations and start spending the money before the end of the year so they could retain the 26% credit now don't have to.
Right now, if you get the check, the stimulus check, and you get unemployment benefits, are they taxable?
The stimulus check isn't taxable. It's an advance payment of a tax credit. So to the you'd have to, when you fill out your tax return, you're going to fill out a form for this tax credit, and that will determine math. You know, the math will dictate whether or not you were entitled to the full amount of that credit that you got an advance payment of. Unemployment benefits may or may not be taxable, depends upon, again, your level of income, your other income.
You know, with all the regs and everything else for the individual, it hasn't said to them if they have to pay taxes or if they don't.
They might.
What's your thought? Mark, do you think they're going to have to pay taxes on this income?
Well, there's the refundable tax credit that Mike was alluding to, which is what we call the stimulus payment, which should not be taxable. However, the extensions of the pandemic extra amounts, I believe it's $300 this time around, and the unemployment benefits traditionally that are administered by the states have and unless there are exceptions, have been subject to tax.
Okay, with 30 seconds left, your final thoughts and comments with regard to the act. Mark, Mike, and then Abe.
Okay, great. I'm amazed that Congress actually pulled this together, and I'm surprised that the president actually signed it when he did. It is a voluminous bill that includes a lot of provisions. I personally like the appropriations provisions dealing with new submarines and destroyers and so forth. However, the tax bill and the tax provisions are a welcome relief to both businesses and individuals, and we look forward to really learning more about how to implement these provisions and help our clients.
Mike?
I think it'd be a lot easier for people to understand generally if Congress would stop mashing all these things together. Pass an appropriations bill as an appropriations bill, pass a tax bill as a tax bill, and pass a stimulus bill as a stimulus bill. Because when you mix it all together, it just becomes very confusing for people to understand. That being said, like Mark said, I'm very grateful that it actually passed because I think there's a lot of help in here for a lot of people.
Abe?
Yeah, I would agree with that. I think there's a lot here for a lot of businesses. And I think the takeaway is that people really need to make an effort to find out what's in here that could be beneficial to them. And everyone should be talking to their accountants and their tax advisors so that they don't miss out on any opportunities, because there's lots in here.
Okay, so I'd like to thank Mark, Mike, and Abe, and I'll see you next week.